Okay, fun seekers, have we got a presentation for you? Now, I'm going to do my best to keep this under an hour. It's a slog. Feel free to stop, take notes, start again, because this is everything you need to know about being charged for mutual funds in one presentation. And again, you're going to be the investment guru for your friends and family and coworkers, so you can't let them down. Slide 21. Get out that study guide, get a sheet of paper, 3x5 cards, you make notes, flashcards. You're gonna have to learn this stuff, folks. You need to know it. Every mutual fund has annual operating expenses. Well, actually, there's a couple that don't. They're called loss leaders. Fidelity actually has a few mutual funds where they don't charge you any annual operating expenses. How do they do that? It's like Costco and their $1.50 hot dog. They just want to get you in the door. The highest amount of fees are usually the management fees. These are anywhere from 0.25% to 2% based on the percentage of the fund's net asset value. This is paid to the people in the top hats. This is paid if a mutual fund is doing their job, and if they're going around and knocking on doors of companies all around the world, it's not an inexpensive endeavor. It costs a lot of money, and these people are paid very, very well. Now, what does this 0.25%, 2% mean? Say it's 1%, which is not atypical. That means for every $100 you have in the account, every year $1 is going to go to the mutual fund company to do the job they need to do. If it's 2%, that's $2. If it's 0.25%, that's 25 cents. You got it? Because this is important. We're going to come back to this idea over and over again through this presentation. The next category are called 12B1 fees, which are really a stupid name, but it comes from the Investment Company Act of 1940. And these are the fees annually to defray the advertising, servicing, and distribution costs of the fund. Typically, they're about 25 cents, 0.25, but they can go up to $1 per year. Now, wait a minute. Does Coca-Cola have to show you how much they're paying for advertising, or Nike, or banks or life insurance companies for that reason, for that matter? No. But mutual funds have to show you in the prospectus that nobody reads how much they're charging you to actually advertise the fund. Interesting. Then there are accounting and other expenses. Now, these are usually fairly low. And that's, the rent, the utilities, the internet, all the janitor services, all the other expenses, as well as the accounting, very important, the accounting firm, that go into running a mutual fund. Now we see, if you're looking at the screen, there's a little line there. All mutual funds have those three. The fourth one here is a trustee fee. That's if you have some kind of retirement account, traditional IRA, Roth IRA, educational savings account, 529 plan, health savings account. The trustee is actually another trustee, not the one we talked about, the custodian that holds on to the shares. This is a custodian, this is a trustee that's actually holding on to your money. And that's because of the IRS Internal Revenue Code. The IRS says, look, if you're going to have a traditional IRA or a Roth IRA or one of these other retirement accounts, 401ks, 403bs, they have their own, what they call third-party administrators. But it's the same idea. Don't worry, no one's going to run off with your money, but you have to have this trustee in between you and the company, so that the IRS says, no big deal. It's okay for you to not pay taxes on the amount of money you received from that retirement account in that year. When we go to discuss retirement accounts at the end of the semester, if it's a traditional IRA or what's called before tax, you pay income tax when you take it out. If it's a Roth, or sometimes called after tax, post tax, you don't pay any taxes. Very cool. But that's typically $10, $30 a year upwards. I've seen it a little higher somewhat. But that's not for regular accounts. Okay, slide number 22. Trading costs. So we looked at the annual operating costs, and we're going to see those coming right out of the prospectus. But the trading costs are not included in the annual prospectus. So how do you know how does an investor know how much the trading costs are? Well, you can actually ask the mutual fund. Or it's just easier to look at the annual turnover rate. It's a measure of how much trading the mutual fund does. It's measured in a percentage of the amount a portfolio turns over. So 100% turnover means in 1 year, they have bought and sold all the securities, stocks, bonds, whatever, that are in the mutual fund. If it's a 50% turnover, that would be 2 years. If it's a 200% turnover, that would be 6 months. You see how this is working? And sometimes you'll see mutual funds that have huge turnovers, and you go, wait a minute, are they really investing or are they trading? Well, I would submit to you that if it's a stock mutual fund and they have a turnover of 188%, and I've seen them, that means they're holding on to a share of stock for less, almost a little bit more than 6 months. That's not investing, that's trading, and that's speculating. They're not owning the stock, they're renting the stock. One caveat. When you look at money market mutual funds, which we discussed in chapter 1 in detail, and we'll come back to them in this chapter. If you look at those and you see turnover rates of 400, 500%, you go, what's going on? Well, remember, what they buy are only good for 30 days or 90 days or 6 months. So obviously they have high turnover because the stuff doesn't last that long. But some stocks have been around for over 100 years. So we just have to have that caveat. In general, in my humble opinion, I'm looking for a mutual fund that, 25% or so, 30%. That means they hold on to the stock for about 3 to 4 to 5 years, 20%. And we're going to see why that 3, 4, 5 years is such a important or interesting, should we say, attractive or provocative, whatever word we're looking for. There's a reason why that. And we're going to come back to that when we get to valuation of stocks. Now you'll see some mutual funds that have very low turnover rates. And that's sometimes good, sometimes it's not so good. Depends on what the situation. We have to go into more detail later on with regard to, say, what are called index funds, which we'll discuss those later on. Next slide is slide 23. The eternal debate of whether you should own a load fund or a no-load fund. Well, many years ago, when the mutual fund industry started, all funds came with a sales charge. Yeah, there were stockbrokers, or whatever you want to call it, representatives. A registered representative is the legal term. Would show a client a mutual fund that would have a load. Then new mutual funds came online and said, well, you know what? We're going to bypass the brokers, and we're going to go direct to the public and not have a sales load. Well, all things being equal, you'd rather have a no-load fund with not pay a sales commission than a load fund, right? Well, the problem is all things are not equal. Some no-load funds have high annual operating expenses, and some no-load funds have lower annual operating expenses. So over the long term, a no-load fund might wind up costing you more than a load fund. Now, obviously, if you're the kind of investor who likes to buy and sell, in which case I would submit you're more of a speculator, you're a trader, then yeah, you don't want to be swallowed up by commissions. Yeah, but if you're a buy and hold kind of guy or gal, which is what I am, and the funds are good, and you believe you need the help of a financial representative, an advisor, a stockbroker, whatever you want to call us, then I think, and we're going to see as we go through this presentation, that the load funds will almost always come out better in terms of the long-term fees for you. Fewer fees for you, the investor. So slide number 24. Now here's where it's going to get a little hairy, folks. Come on, get that pencil and paper out. Get that study guide out there. What are the different types of load funds? Well, the very first type of load fund was the front end load. Now they are typically called Class A, although some mutual fund companies might call them Class 1 or something other. But Class A. These are the funds where a commission is paid when the shares are purchased. They normally, but not always, look at each one separately, will have lower annual operating expenses. Well, people didn't want to pay that commission, especially when here's a mutual fund that's not charging any commission. But I do believe I need the help of a financial advisor, and Ms. Financial Advisor seems so nice. But you say to her, well, I really don't want to pay an upfront fee. And she says, no problem, sit down. We have the Class B shares for you. The commission is paid when the shares are redeemed. Well, wait a minute. What difference does it make if I pay the commission up front or on the back end? Well, what happens is most of these Class B shares will have what is called a contingent deferred sales charge. Isn't that a great name? Contingent. It just sounds so much. It feels good when you say it. Say contingent. Down in the bottom of your throat. What this means is that, yes, there's a back end charge, but it goes down over time. It might start at 5%, and then next year 4%, 3%, 2%, 1%, and after 5 years, no more back end charge. Remember, Mr. and Miss John Q. Investor, you're in it for the long term, right? You're not going to be selling your shares right away. Oh no, yes, we're Ms. Broker, we're in it for the long term. But okay, how do they get you? Normally, the back end load shares pay higher annual operating expenses through the 12B1 fees until that contingent deferred sales charge declines to zero. And then typically they will revert back to the Class A shares, which have the lower annual operating expenses. Are you confused yet? Good, because it's going to get even worse. We've done our job if we've confused you. Class A upfront, Class B back end, but that back end charge goes down over time. The next category are called the Class C shares, and they used to be called no-load broker funds, but now the Securities and Exchange Commission says, no, you can't do that. Well, we'll see why. They had no front end, no back end commissions. Well, they'll hit you with 1% if you take the money out within the first year, which is, you don't want to do that. Mutual funds are not trading vehicles unless you go with the ETFs on a brokerage account. So yeah, you're going to leave it in for at least a year. But again, nothing's free. Most Class C fund shares have annual operating expenses in perpetuity. You like that word, in perpetuity, or for a long time. And through the 12B1 fees, right? And so they eventually become Class A or some other class. After 8, 9, 10 years, they will fall back and have lower annual operating expenses. Hence, they can wind up costing you more than the Class A or Class B shares. But if you're paying more for 10 years, it's worse than paying more for 5 or 6 years. But what happened? The Securities and Exchange Commission came in and said, no, you cannot call this a no-load fund if the 12B1 fee is greater than 0.25%. What? Wait a minute. Yeah, they were sneaking the load into the 12B1 fee, and so they were saying they were no-load funds, but the Securities and Exchange Commission is saying, no, you just stretched out. You amortized the load over 8, 9, 10 years. So now they cannot be called broker no-load funds. Now you're really confused, right? All right, so now those are the three major commission, sales load, broker, sales load share classes. So get them in your little head. Remember, these are all the same mutual fund. It's just the share classes are how you get charged. Now we're going to take a look at no-load funds. And there are two major categories. There's the advisor no-load fund, often called advisor shares, or Class F for financial advisor, or Class I for investment advisor. These are sometimes called clean shares. Yeah, right. They're not clean in my humble opinion. Held in the advisor's wrap account, wealth management account, assets under management. This is the modern go-go way to to charge for investment services. Because what happens is you get those annual operating expenses, those low annual operating expenses. You don't pay any upfront fee, you don't pay any back-end fee, no high 12B1 fees, but the advisor tax on an extra 1 or up to 2% every year to manage the account. We're not your brokers. Oh, no, of course not. We're your wealth managers. And it turns out that these puppies can wind up costing you more than all the others, not combined, but they could wind up costing you more than the others. But this is what the industry does now. I'm old school. I'm a broker. I could do this. I don't think it's in the best interest of the clients. And I'll tell you probably 2 or 3 times some stories about how people have just how the industry feels about their clients. And you're seeing more and more things in the media about people who realize how they're being charged, and they're not too happy about it. So let's continue. The last category are the true no-load funds. Now, we put true in quotes because the IRS doesn't call them that. The industry doesn't call them that. The financial media calls them that. The mutual fund company deals directly with the public. They may not have a 12B1 fee greater than 0.25% or 25 cents for every $100. These are the darlings of the popular media. Bypass the middleman. Who needs a financial advisor? Just watch my cable news show, cable financial show, read my book, sign up for my $50 a month, whatever. But that does not mean the overall fees are low, right? As we said, if a no-load fund has high annual operating expenses, it can wind up costing you more than a load fund. You must look at all the fees combined. You must compare the annual operating expenses and see if they're far more than your load fund, and see if that over time will negate the fact that you didn't pay a commission. So you have these 5 major categories, right? You have them written down. You're going to commit them to memory because now we're going to take a look at some real life examples. We talked about Alliance in the last presentation. Well, this is what Alliance is called now, AB. What a stupid name. Well, Alliance merged with a company called Bernstein, and then they called themselves Alliance Bernstein. And I guess that was just too long, so now they call themselves AB. And this is the AB Large Cap Growth Fund. It is now closed to new investors. I don't know, maybe they did open it. I'm not sure. Oh, the B shares. Oh yeah, the B shares are gone. That's what's closed. The A shares have an upfront fee of 4.25%. Okay, so you put $100 in, that means you pay $4.25. You put in $1,000, you pay $42.50. You put in $50,000. No, once you get over certain break points, then the percentage goes down until finally most mutual fund companies, if you put in more than $1 million, they won't charge you any commission. See how the industry loves very rich people? Yeah. So anyway, let's stick with the maximum. See, it says maximum sales charge. It might go to 0. There's no other fees on the sales, but the managers are going to charge you 48 cents for every $100 that's in the account every year. And then there's the 12B1 fees for servicing, for marketing, selling the mutual funds, and 12 cents for other expenses, rent, the lights, utilities, janitor services, internet, whatever. And so every year in perpetuity, they're going to be charging you 85 cents on every $100 that is in your account. Does that sound like a lot of money? Well, dear students, it's a whole lot less than the bank is charging you, and then the life insurance companies are charging you. But Does the bank, does the life insurance company have to show you how much they're charging you? No, no. But the mutual fund company does, courtesy of the Investment Act of 1940. Now, notice that the Class B shares are crossed out, closed to new investors. Well, what they did is they got rid of them. The Class B shares were popular for some time, and now most mutual fund companies have just said, forget about it, we're not interested in it. The insurance companies still have that contingent deferred sales charge, back end charge, or whatever you want to call it. But most mutual fund companies are getting rid of them. But notice what they did. Everything was the same, right? Well, maximum deferred sales charge, the contingent deferred sales charge was 4%, which means first year if you took the money out, they'd take 4%. And then the second year, 3%, third year, 2%, the fourth year, 1%, and after 4 years, it was gone. So, okay, that's called the contingent deferred sales charge. But if you held on for 4 years, you didn't get charged anything. But they still charged you 48 cents for the managers, but those people are the same people for all share classes. They're the same people running the fund. They're making the investment decisions. They're knocking on Ford and GM, and they're knocking on IBM and all the other technology companies. And so that notice is across the board, 48 cents. Look what happened to the 12B1 fees for both the B, and then we're going to see for the C shares also. Right, they jacked up the sales charge to $1 from 25 cents. That's how they paid the commission. The other expenses were higher, and so $1.64 every year, $1.64 for every $100 you have in the account. I think Alliance, it's after 6 years they revert back to the A shares. I'm not sure. I got to go back and look, but they don't have the B shares anymore. So it doesn't matter. The C shares are no upfront fee. Well, a 1% fee if you take the money out within 1 year, which you're not going to do that. Don't do that. That's not what mutual funds are for. Same 48 cents, and then there's the dollar. Yeah, 1% and 12 cents. So $1.60. And they do that. I got to go back and remember. Is it 10 years? I think they do that for 10 years in Alliance. I got to go back and look. My apologies. It's in the prospectus that nobody reads. So you go to your Miss Broker. I don't want to pay an upfront fee. No problem. We're not going to sell you the Class A shares. I don't want to pay any back-end fee. No problem. We don't even have them anymore. And I don't want to pay higher annual operating expenses for 8 years or 9, 10 years, Ms. Broker. No problem. You see, everything's no problem. For you, we have the advisor class. They used to be called Class F. Now they call them Class Advisor class, whatever. No upfront fee. Look, lowest annual operating expenses of all three of them. What a deal. Oh, by the way, we charge you an extra 1 or 2% every year on the row. What was that, Miss Broker? What did you say? We charge you an extra 1 or 2%. We charge you an extra 1.25% on top of everything for our broker wealth management fee, assets under management. And you see, you're going to wind up spending more over time with these wealth management accounts. And about, I guess about 15 years or so ago, when this was still being hashed out, and there was old folks like me saying that keep with the commissions, and new folks saying, no, we want to we want to charge a wealth management fee. I was at a seminar of something. I think I've said it. I've already told you somewhere else. I'll tell you again because it's so important. And we're all suited up. I'm trying to act the part because I don't look very good in a suit. I don't look very good anyway, but I'm trying to act the part. And we got on the subject. It was at a seminar where we were sitting around a table. And when it was my turn, I said, well, I don't really believe that the wealth management fee, the assets under management, is in the best long-term interest of the clients. Obviously, if you have a client who likes to buy and sell, well, then they don't want to be paying commissions. They're going to get eaten alive. But if they're buy and hold, long-term, prudent investors, and those are the clients I want, then they're better off paying the A share upfront fee and being done with it. And this guy looks at me. Now, his suit, if it was $1,000, no, it was probably more. His hair was perfect. He just looked the part. And he said, what are you worried about? You send them a bottle of wine on their birthday, take them to the steakhouse, take them golfing. They'll love you. And I didn't know what to say. Usually yours truly has some kind of comeback, but I just thought, how am I going to argue with that? I mean, obviously he doesn't believe that it's not in the best interest of the clients. He believes that the fact that you're taking them to the steakhouse and holding their hands is worth that extra money, even though you'd be doing that anyway with the A shares. So I don't know, but that's what we're up against, and that's what you're going to find in the industry. The one guy, Ken Fisher, we're going to tease Ken Fisher, 1.25%. He has his gravelly voice. If you have a $500,000, you need to talk to me because I want to take 1.25% of it. And then we're going to see in some ancillary presentations on what show. Make sure you look at them. That going with the A shares versus going with the assets under management shares. The assets under management shares are going to cost you dearly. Oh yeah. So that was the Alliance Large Cap Growth Fund. Let's take a look at another fund called the Legg Mason Value Trust. Actually, it's not called this anymore, is it? No, it's not. But this was a very famous, now infamous company, mutual fund, for many years because it was run by none other than Bill Miller. And we'll discuss Bill Miller when we get to Chapter 6 and ask who can beat the market. Now, they have a maximum sales charge in their Class A shares of 5.5%. And notice the management fees are 0.69, more than the Alliance. And that's across the board because those are the people in the top hats. They get paid the same no matter what. They have distribution and or service fees, the 12B1 fees of 25 cents, and then other expenses of 8 cents. So $1.02. So a little bit more than the Alliance Large Cap Growth Fund. They don't have the Class B shares. They do have the Class C shares, which they used to call the primary class. Those were the only shares they had, actually, for many years, along with the institutional shares. So no upfront fee. There's a back-end fee of 9.95%, almost 1%, if you take the money out within a year. But you're not going to do that, so forget that. Notice what happens. Right, 69 cents for the management fees, still the same, but the distribution and or service fees go up to almost $1. And 11 cents for other expenses, and so you pay $1.75. And as I remember, I got to go back and look. These Class C shares do not revert to the A shares. As I remember, I got to go back to the prospectus and look. I apologize. I really should do that, but I didn't. Now, what are FI? Right, these are the financial advisor shares, financial investment advisor, whatever. No upfront fee, no back end fee, but hey. They actually cost more than the A shares. And the financial advisor is going to charge you an extra 1 or 2%, 1.25% or whatever. So what a bad deal that is, in my humble opinion. Plus, this is no longer called the Legg Mason Value Trust. It's now called the ClearBridge Value Fund. Why did they change the name? You'll see later. It's called burying the evidence. Now, what about these institutional shares? Whoa, 0.8%. That's lower than all the others. Do you have to be institutionalized to? No, these are for pension funds, for life insurance companies, organizations such as endowments and the like for universities and hospitals and like. You have to be an institutional investor to get these shares. So they're not for you or me. The next one is the T. Rowe Price Blue Chip Growth Fund. And notice that T. Rowe Price was one of the first mutual funds that said, we're not going to have upfront fees. No, 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 no. We're going to have the investor class, which is the typical class that people buy. They have a totally different share class scheme. You see, this is what you're up against. But what you're going to find is that they always all fit in one of the 5 categories, unless they're really, really an oddball, which we're going to see an oddball here, the Class Z shares. So no upfront fee, no back end fee, 55 cents across the board, except for Class Z. Why is that? These Class Z are a real oddball. Hang on a minute. And so notice, they don't charge service fees. Interesting, T. Rowe Price. And then 15 cents for other expenses, so 70 cents, which is, typical, right? No upfront fee. The Class I shares, now, what are those? Why are they different? Something's going on, but they're very similar to the investor class, but there's something about the Class I shares that you get a better deal. Maybe we ought to investigate that. Maybe we ought to download the prospectus and figure out why the investor class is paying more than the Class I shares. Nah, it's too much trouble. No, do it. Do it. Do it. On the website is the link to the T. Rowe Price Blue Chip Growth Fund prospectus. Check out why the Class I shares have better expense ratio, has a lower expense ratio than the investor class. Now, T. Rowe Price has been popular, has been very successful over decades. I think they started in the 1950s. And so advisors said, well, we'd love to represent you. Can you give us an advisor class? And so T. Rowe Price says, okay, the advisor class, it charges more than either the investor class or the Class I shares. So for some reason, you have this funny feeling that the advisor, maybe, I'm not sure, I'm not familiar with it, so I don't work with it. But I don't work with T. Rowe Price. But they're a very good company, Don't get me wrong. Very good company. Maybe that's what they give the advisor, the 0.25%. So maybe the advisors who choose T. Rowe, I'm speculating here. I don't know. I've never worked with them, so I don't know. But maybe this is what they limit themselves to, 0.25%. I doubt it, because most brokers want at least 1.25%, upwards of 2%. And so we should do a little bit more. We should pull out that prospectus and take a look. Now, what are these Class Z shares? No fees. What's going on here? Well, this is a little bit of an anomaly. T. Rowe Price, along with most other big mutual fund companies, have these target date or target retirement funds. The thrift savings plan, which is part of your assignment, calls them lifestyle funds. And so what this was meant to do, and actually they're very useful for many people, you walk into a position at a company and they say, we have this 401k plan, and they give you this booklet or they give you a website to go to. And there's all these options. And you don't know where to start, right? You haven't taken Business 123 Introduction to Investments yet. And so you look at the target date funds or target retirement funds. And you see, oh, here's one for 2050. That's about when I'm going to retire, 2050 or 2060 or 2040. And you choose that fund. Well, what does the mutual fund company do? They populate that fund with their other funds. And so that fund has its own annual operating expense. And if it uses the T. Rowe Price Blue Chip Growth Fund, they use the Class Z shares, which have no annual operating expenses. So in other words, you're not getting charged twice. You're getting charged via the target date fund. And we'll discuss these in detail in our next presentation. Plus, you're going to do some research. You're going to research the thrift savings plan, which is the 401k plan for federal employees and the military. It's actually a very good plan, folks. Very good. It's simple. That's why I love it. It is very, very simple. And that's why I think it's a good thing to study. And of course, if you work for the government, the federal government, you should be familiar with it. If you're not, it's about time. And this class is going to make you become familiar with it. Slide 30. And now for something completely different. I'm an old Monty Python fan. This is an index fund. This fund does no research. All the funds that we took a look at already, the 3 funds actually, we only looked at 3, have been actively managed. They have research analysts, portfolio counselors, portfolio managers that go all around the world, knocking on the doors of the companies, deciding which companies to buy or not to buy. An index fund does not do this. Remember the people in the top hats? You and I could be one of those people. Because all we do is we look at a list. They're called indexes. And if it's on the index, we buy the stock. If it's not on the index, we don't buy it. It's that simple. There's no research. The most popular being the Standard & Poor's 500 index. It's a list of about 500 of some of the largest companies, mostly the largest companies, based in the United States. It's been around for decades. The term for this is passive management, and we're going to discuss active versus passive management in detail in the next couple of presentations, because this is where we talked about the controversy over the portfolio managers being paid very well and maybe not earning their money. Index fund proponents say, yeah, they're all bums. Just buy the index because nobody can beat the market. We're going to find that that's patently incorrect. There are people who have beaten the market over decades, but people don't like to be confused with the facts. But the one cool thing about an index fund is there's nothing to do other than look at that list. So notice that their management fees are 4 cents. Well, they better be, because they're not doing anything other than looking at the list and buying those stocks. And if they're not on the list, they don't buy them. There is a $25 annual fee if you're less than $10,000 in your account, or all you got to do is enroll in electronic delivery and they'll waive, WAIVE, that $25 annual fee. And the other expenses, they're not zero, but they're pretty darn close, so they don't even show up, 0.00 whatever, 0.0045 or whatever. So in reality, you're paying 4 pennies, 4 cents on every $100. Cool? Now, this is the newer version. The previous version was 14 cents. So it reminds me of limbo. How low can you go? We're going to find out that one company, Fidelity, went to zero. And here it is. Fidelity used to be the #1 mutual fund company until Vanguard pioneered low-fee mutual funds and overtook them. What did Fidelity do? If you can't beat them, join them. So they responded by eliminating sales loads, creating their own index funds, and lowering their fees below Vanguard. So here's their 500 index fund. No upfront fee, no back-end fee, management fee of 0.014. And again, they've removed that $12 fee. If your account was below $2,000, they charge you $12. They don't even do that anymore. And 0.001%, penny and a half. A penny and a half they're charging you to put your money in the Standard & Poor's 500 index fund. And as we said, I made mention, some of Fidelity's index funds are now free. And for you business folks, marketing folks, that is called a loss leader. You're not making any money. I mean, obviously, it costs some money to run a mutual fund. Now, not the 500 index. I forget which. It's a couple of the other index funds. But you're actually losing money on that. But why would you do something like that? Well, we made mention of the Costco $1.50 hot dog, and they still sell that chicken for $4.99. They don't make money off of those. They don't care. They want to get you in the door and have you buy a $2,000 high rationalization television set. Brilliant. Geniuses. So you see, index funds should be very, very inexpensive. But be careful, because insurance companies are running some of these 401k plans, and they will sneak in index funds with high fees. Why would they do that? Because they can. The big jerks. Look, folks, I'm an insurance agent as well as a stockbroker. I say true things about both of them. And sometimes I got people really angry at me a few times when I would say these things. And one guy was about ready to punch me in the middle of a seminar with all his buddies and everybody around. His buddies, and I'm a coward. I ran away. Cowards run in my family. When I saw him getting really hot under the collar, I just started backing up and getting out of there. And they went over him. His buddies went over and said, "Were you nut? Are you some kind of nut? You're going to get thrown in jail. You punch somebody in broad daylight for no reason at all. It's just that you're upset because he doesn't believe what you believe." And he came over afterwards and apologized. But it was amazing how some people get really upset when you confuse them with the facts. So now, let's take a look now at the costs over 1, 3, 5, and 10 years for couple of these funds. Here's the AB Large Cap Growth Fund. And again, folks, this is all in the prospectus, right? So the A shares start costing more. Notice they use $10,000. I don't know why, but that's what the SEC tells them to use. On a hypothetical, meaning sort of make-believe, 5% return. The A shares wind up costing you more over 1 year and even 3 years. But after 5 years, they've caught up. And after 10 years, who's cost you the least? The A shares. The B shares, which are basically gone, well, were the most, and the C shares were not far behind. Now, obviously, because of the low annual operating expenses of the advisor class shares, it looks as though the advisor's share class are the best deal. But we're not including, see, it says excludes advisor's fee. We're not including the 1 to 2% per year. That could easily add an additional $1,300 to $2,600 to the total cost. So which is the best deal over the long term if you believe you need the help of a financial representative? The upfront fee, A shares. That's my story, and I'm going to stick with it. Other people don't want to hear that. They, mostly brokers, of course, because the most popular way to soak your clients, to charge for investment services is through the assets under management method. Yep, okay, that's what you're up against. Now, the next one is the Legg Mason Value Trust, now called the ClearBridge Value Fund. Again, the A shares start off costing you more, but eventually the C shares wind up costing you more. The financial intermediary shares really aren't that much cheaper. Plus, you got to tack on the the advisor's fee, which is not in this calculation. So add another $1,300, $2,600. And the institutional are the best, but are you a large pension fund, a university endowment, a tax-exempt charity, and do you have at least $1 million to invest with us? Get out of here. Yeah. Now, index funds, here's the old one that charged 14 cents. Here's the new one that charges 4 cents. The fees for passively managed index funds will almost always be less than actively managed funds. Vanguard closed the old one, the investor class. That was the first one. It came out in 1975 or something like that. And now wants investors to use the Admiral class shares with a minimum of only $3,000. But I think if you go to Vanguard and say, I want to start putting $50 a month, they'll say, no problem. Do you remember the exchange-traded funds that we talked about? Well, the ones that are index funds, and not all exchange-traded funds are index funds, often have lower fees than the index funds. The Vanguard ETF that tracks the total stock market has an expense ratio of 0.03. Limbo, 3 cents. And as we said just recently, Fidelity now has 4, I should check, maybe they have 5 now, 4 index funds with 0 annual fees. So click on that and see what happens. How can they make money doing that? This is called a loss leader. Now, you might have noticed there's a little asterisk after the first line, the first sentence. The fees for passively managed index funds will almost always be less than actively managed funds. Not necessarily. So careful, look at the fine print at the bottom, if you can read it, my apologies. Careful, some 401k plans now have high fee index funds. Huh? Why? What would they do that? Because they can. You know, it's almost always insurance companies, folks, so be careful. Who would do that to their employers? Well, Southwestern College, for one. And nobody believed me. I kept complaining the whole time. The two, I felt sorry for them. They were going to give it was a new plan at Southwestern College. It was 2002. And they're going to give a presentation. And, our college hour is about an hour. That's why they call it the college hour. And it usually starts late anyway. So these guys had a presentation that somebody gave them. I don't think they even looked at it. It was like 70 slides. 70 slides in 40 minutes? These guys have never given a presentation, obviously. So they're flipping through there and they don't know what the hell they're doing. And I'm looking at the materials. I got they're passing out the prospectuses, and they had this Galtmore or whatever, I forget the name, index fund that tracked the S&P 500. 90 basis points, meaning 0.9%, 90 cents on every $100. And I said, they didn't expect me to be in the group. I said, excuse me, what's this with this Galtmore 500 index fund that's charging almost 1%? Oh, we're sorry. Yeah, we're going to get another one. That's just temporary. Well, they did. They replaced it with their own nationwide on your backside index fund, which I think was 60 basis points, but then they added another 30 basis. So it wound up being almost the same. And I kept telling everybody who would listen to me at Southwestern, these people are screwing us. They are giving us the screws. And finally, because I mostly talk to the folks in human resources, right? Because they're the ones in charge, benefits department. Finally, one of the people, one of my colleagues there who worked in benefits, took my class. And she said, you're right, they're screwed. I told you they're screwed. Well, then she must have talked with the vice president in charge of very important things, something like that. Well, about a year later, we were in a different plan, which was better, but still not as good as it should have been if it had been run by not an insurance company. So it went from nationwide on your backside to Endeavor, which is basically, it's called Great West Insurance Company. Better, it's definitely better, Endeavor, but it's still not. If I were running it, it would be a lot better, but I'm not running it, so that's it. So much for that. All right, now, if you go with a financial advisor, you want to make sure that that financial advisor explains to you the breakpoints. Here are the breakpoints. If you have less than 100, this is the AB Large Cap Growth Fund. If you have less than $100,000 either purchased or accumulated, once your account goes above $100,000, you're going to pay 4.25%. But between $100,000 and $250,000, that sales charge goes down to 3.25%. Once you hit $250,000, it goes down to 2.25%. Between $500,000 and $1 million, it's 1.75%. And once you either pay, buy $1 million worth of shares, invest $1 million, or your account goes over $1 million, no more sales charges. So some brokers would fail to inform their clients of this feature. Instead, as the client approached the breakpoint, they would advise them to start another fund. Now, why would you do that? I mean, you're going to get caught. You're going to fool most of the people, but eventually somebody's going to figure out that you did that just so you could keep the commission high. And when I first heard this, I just said, no, don't do that. You're going to make all of us look bad. Now, if a broker does this, you can lose your license. Plus, you get fined, and you have to pay back the clients what they would have, pay back the overage that they had to pay. And so I apologize on behalf of the industry. That's why you need a good referral. There are crooked teachers, crooked lawyers, crooked doctors, there's crooked mechanics. They're out there, folks. A lot of them are in Congress. Anyway, so slide number 36. There's the reduction, the contingent deferred sales charge over time. And this is again for the Large Cap Growth Fund. 4, 3, 2, 1, until after 4 years, you don't pay the contingent deferred sales charge, the back end fee. And as I remember, for Alliance, it was 6 years. Now, get this. Remember, I told you, be careful of insurance companies. Insurance companies have this same kind of thing. They don't call it the contingent deferred sales charge. They call it a surrender charge. But they usually start at 20 or 25%. 20 years! I've seen some as low as 10, but usually 20 years for the contingent deferred, what they call surrender charge, to go down. Yeah. Don't trust insurance companies with your investments. Trust insurance companies with your insurance needs. You need life insurance because you have kids. You need a car. You need car insurance because you have a car. You need home insurance. You have home insurance because you have a home. You need health insurance because, God forbid, something bad happens. But investments, no. And I could sell these things. I could. I'm an insurance agent. I won't do it. No, thank you very much. And that's what the that I told you about the spat was about. This one guy was keen on annuities, which are just bleh. And he he was angry at me for ditching annuities. Slide number 37. Okay. Oh, oh my God. 50 minutes. Not bad. Okay. I know you've taken breaks, right? But you got to learn this stuff. I'm serious. It's going to be on the test. But more importantly, you have to be able to explain to your friends, family, your colleagues how they're being charged in their mutual fund. So now that you know everything you need to know about the different asset classes, which mutual fund would you have chosen? I'm going to give you $10,000 10 years ago. Would it be the AB Large Cap Growth Fund? Class A, of course. The Legg Mason Value Trust, now called the Clearbridge Value Fund. The Class C shares, because that's what they were pushing. The T. Rowe Price Blue Chip Growth Fund, the investor class. Or the Vanguard Index 500 Fund. Or maybe you didn't qualify for the Admiral shares back then because they still had, 10 years ago, you still had to have $100,000 to get the Admiral shares. But let's give you the Admiral shares anyway. Who do you want? Who do you want? Okay, drum roll, please. Let's read first. Fees are important, but they certainly do not tell you the whole story. When comparing mutual funds, you must look at many attributes, not the least of which are the rates of return, preferably over long time periods. Now, what was unusual about the last 10 years? Growth. Technology, growth. Yeah. And so the AB Large Cap Growth Fund, as I said, it's a very good fund, returned after the upfront fee was paid. After the upfront fee was paid, 15.39%. That is not bad. In fact, that is pretty darn good. If you had got it at net asset value, whoops, I didn't mean to do that. Oh, goodness gracious, my mouse is so sensitive. If you had gotten it at net asset value, you actually got almost 16%, 15.9, 43,372, right? Without the sales charge. The T. Rowe Price Blue Chip Fund did pretty darn well. It beat the S&P 500, returning 14.62% for a total of $39,138. The Index 500 Fund almost matched the Standard & Poor's 500 index. Well, remember, the index itself doesn't have any fees. So that, what was that, 4 cents or something? Yeah, 4 cents. That makes sense. Between 0.82 and 0.86, that's about 4 cents right there. So you wound up with 33,400 or 33,500 if you were able to invest in the S&P 500 index purely, but you can't, so don't bother. But look at the Legg Mason Value Trust. Yeah, you see, this is what could happen with actively managed funds. You could beat the S&P 500 or do pretty darn close, or whatever index the fund is supposed to measure, or you could lag the index quite substantially. And the reason we chose the Large Cap Growth Fund from AllianceBernstein and the T. Rowe Price Fund is because they've consistently done well over decades. And that's what I, as an investor, I'm looking for. I'm looking for mutual funds that have done consistently well over good times and, more importantly, bad times. And as we said, the last 10 years are a little different than usual. And we'll talk more about growth and value and later on in the semester. But you could also do pretty poorly too. You could pick a very poor mutual fund. And the reason we picked the Legg Mason Value Trust is because it used to be one of the most popular, best returns ever. It was run by, many years ago, a man by the name of Bill Miller. And we'll come back to Bill Miller in chapter 6 when we discuss the who can beat the market. And he clobbered the market. He was doing so well. And people would say to me, if you had looked at this, not what, about 10 years ago, no, 9 years ago, people would say to me, why don't you invest? Do you invest with the Legg Mason Value Trust? I said, no. I said, why not? I said, well, here's why. Mr. Miller believes in concentration. He keeps about 40 to 45 stocks in his mutual fund, which is very untypical, right? Very atypical. And I like to see, at least 100, 150 or so. And so you live by the sword, you die by the sword. He beat the S&P 500 15 years, calendar years in a row. And everybody just thought the guy was invincible. And then he really, really lagged the market for a few years in a row. And eventually, I think after 5 years, Legg Mason let him retire. But he's back in the industry. And they buried the evidence. They changed the name from Legg Mason Value Trust to ClearBridge Value Trust to eventually ClearBridge Fund. This is so typical in the industry. They will take a bad fund, change its name, or merge it into something else. Remember from last chapter, Janus 20? Yeah, 20 stocks? Well, when it fell into a pool of tears and dissolved, they merged it into Janus 40. Out of the frying pan and into the fire. And so this is why we really need to do our research. Look, and we're going to talk about this more because this is the hardest part of mutual funds. Look for companies that have been around for decades and have done well in good times and, more importantly, in bad times. Okay. Oh, I know you're exhausted. Oh, I promised an hour and we're almost there. So now we have checking for comprehension. These shares do not have an upfront sales load. Instead, they assess a decreasing back-end load if you withdraw your money within 6 years. The annual operating expense is higher courtesy of the 12B1 fees. Are they A, B, C, or the FRI shares? Right, they're the B shares. Think of back-end. They're very rare, but they're still out there, and they're very much out there in the annuity world. Slide 39. These shares do not have an upfront fee and only a 1% back-end fee if you're redeemed with 1 year. The advisor called them no load. He wasn't supposed to do that. But you notice that their annual operating expense is higher than other share classes. Again, courtesy of those ubiquitous 12B1 fees. Are they A, B, C, or FRI shares? They are C shares. They sometimes revert to A shares or F shares after 8 or 9 or 10 years because they don't want to screw you. I mean, I don't want to overcharge you forever, but some don't. And then lastly, your advisor tells you that these shares have no sales fee, a very low annual operating expenses, and she mumbles something about wealth management. These shares are the A, B, C, or the FRI shares? Yes, they're the advisor shares, the F shares, the FI shares. She also did her best not to explain to you that her brokerage firm is going to charge you an extra 2% each year. Now, I know it's hard to believe 2%, but it's happened. In fact, I helped one person. They were going to charge her 2%, and I explained what was going on. She went back and said, this person said 2% is actually high. And they said, oh, no problem. They dropped it to 1%. Boom, right away. Ah! Oh, goodness gracious. They still overcharged her. Oh, now, okay. By the way, let's read at the bottom. There are dozens of other share classes. R shares, T shares, Z shares, depending upon the mutual fund company. But don't worry. Don't worry. They all are variations of the 5 main themes that we learned today. So study those 5 main themes. The A shares, B shares, C shares, the advisor shares, FRI shares, and then the true no-load fund shares. Cool? And we did it. Less than an hour. Go back, study this over and over and over again because you are going to be the investment guru for your friends, your family, your colleagues. They are counting on you. It is a very important and weighty responsibility. You cannot let them down. We are so proud of you. Thank you so much for being in our class. And think about how much you're learning, folks. Most people just have no idea what's going on, but they know that they're being charged somehow. They just don't know how. Now you will be able to explain it to them. In our next presentation, we're going to do something even harder. We're going to try to get our arms around this 800-pound marshmallow called the mutual fund industry and all the different types of mutual funds. See you in our next presentation, dear students. Again, thank you for being in our class.